Dan Fitzpatrick is founder and chief market analyst with StockMarketMentor.com. Dan, welcome. Good to see you, sir.
Hey, Tyler. Thanks for having me.
Oh, we're delighted to have you here. Though I'm not delighted to quote what you say in my notes, and that is that the S&P can fall another 20%, and that may not happen until the third quarter of next year. That's next summer, Dan. I can't wait that long. I don't want this to happen. Give me your thesis.
Well, guess what? I'll start with the good news first.
Okay.
Markets anticipate the end of a recession. We've seen that before, and there's always good stocks to buy during that time. In fact, it sounds kind of counterintuitive to say it, but I think that trading and investing can actually be easier in this type of market, you know, as long as you temper your expectations. And what I mean by that is, most stocks are crap. Most stocks are falling, and so you don't want to stay away from them.
That's really a good one right there.
Most stocks are crap.
Yeah, most
stocks are crap.
Okay. All right.
So you have a very, very small pond where you need to fish, and the easiest way to sort this out is if a stock's not above the 200-day moving average, then you don't see it. Because if you're buying it lower than that, you are not on the side of institutions. So, you know, I don't want to get too far off track, but that would be my optimistic advice is don't give up on the market. Just make sure you're covering your risk right now and keeping some powder dry so that when we do see an improving market, and we will, just not now. I want to get to some. You're able to invest.
I want to get to some stocks that you don't think are crap. Number one, but before we do that, I buy the idea that the market always moves in anticipation of the end of a recession. I know you're saying we're not seeing that in the market now. That's not what the market is reacting to today or on these brief periods of flurries. But we can't even agree on whether we're in a recession or whether one is coming or not. No one seems to know.
Well, I think a lot of people know, they're just not saying it.
Okay.
I just go back to the basic definition, you know, 2 quarters of negative GDP, that's a recession. We're in it. You look around and, you know, nobody that I know is rolling in the dough saying like, oh, my gosh, I got to do this. I got to do that. I see it everywhere where people are a little tentative, and maybe that's just from the news flow. But I think there are deeper things going on here with the Fed funds rate, the way they've jacked it up by. I mean, people talk about like, oh, they've only raised it 3%. No, they've raised it 80% from 0.25. in a very, very short period of time. So that's a problem. And just in general, think about this, Tyler. The last couple bear markets,
80%, they've tripled it or whatever they've done. I mean, it's well over a triple.
It's just been madness, and not to editorialize too much, but the thing I hear is, well, the Fed has to do this to maintain their credibility. And that's assuming the Fed has credibility. They're always late. And this is the case here. It's really just kind of too much, too fast. But, you know, everybody says that. But just technically, you know, this market is broken.